John Crypto here. Buckle up, because what just happened in Bitcoin is not a correction. It's a calculated bloodletting. Prices plunged to $60,008, wiping out retail longs like a financial blender, only to rebound to $67,360 while the world cheered the recovery. Here's the kicker. In the last 24 hours, $165.9 billion changed hands, yet volume is down 8.9%. That's not normal liquidity, that's chaos disguised as opportunity. Now check this. Open interest sits at $95.6 billion, up 2.8%, meaning the smart money is still strapped in heavy, holding positions that could explode on the next twist. Meanwhile, liquidations hit $217 million, down 45% from the prior wave. Retail is bleeding. You know who's profiting? The same names the media won't touch. BlackRock, JP Morgan, and whoever else is orchestrating these invisible traps. The headlines scream, "Extreme fear grips crypto, fear and greed index at 5. They want you to panic. It's just volatility, they whisper. Fake calm, fake logic. Here's the truth. $10.7 billion in BlackRock ETF maneuvers forced these liquidations. That 270 meter wiped out, mostly retail, trapped in margin positions below 65K, screaming while whales quietly snapped up every Satoshi tossed onto the floor. And the proof is staring you in the face. ETF flows tell the real story. Bitcoin ETFs saw $276 million in outflows, while Ethereum only received $129 million in inflows. That's not weakness, that's strategic rotation. Institutions are offloading exposure to panic traders, accumulating where it matters, and preparing for the next squeeze. The retail panic becomes the liquidity for the whale's next play. Here's where it gets really ugly. Open interest rising while liquidations drop is textbook absorption. BitUnix shows BTC futures liquidations concentrated on retail positions, around 145 million. That's not market inefficiency, that's a trap set with surgical precision. Meanwhile, Ethereum staking queues surge to historic highs, signaling institutional confidence that's invisible to the panicked eye. Retail sells, institutions lock, the pattern repeats. Let's connect the dots. Retail saw 60K as a floor. They panicked. They sold. They liquidated. And what did the media do? They amplified it. Bitcoin fear is real, markets unstable. Meanwhile, institutions scooped up coins below 65K like a fire sale. ETF outflows weren't withdrawals. They were a redistribution. A stealth accumulation hidden in plain sight. Volume tells the story too. 165.9 B traded, yet 24H liquidations fell. The market isn't crashing, it's being engineered. Every dip, every spike, every supposed recovery is calculated to extract retail fear and funnel it to the whales. Open interest climbing means positions are concentrated, not scattered. Smart money is positioning for the next move, not fleeing. And don't underestimate the psychology. Retail is conditioned to panic at red numbers. They see 60K, think the floor is collapsing, and dump. Meanwhile, institutions are staring at order books, taking notes, and moving silently. The ETF outflows, a headline disaster, mask the fact that accumulation is happening quietly, systematically, almost surgically. Now here's the tease. You think this roller coaster is random? You think $67,368 is normal after a 16-month low? That spike in ETH staking, the ETF rotations, the concentrated futures liquidations, it's all part of a single invisible play. BlackRock didn't just sell or buy, they drained supply, reshuffled positions, and left retail holding the bag. Next, we're going to track the blood trail. Every Bitcoin that left exchanges, every coin sucked into cold wallets, every ETF maneuver hiding behind a market correction. We'll follow it all. The real story isn't the 67K bounce. The real story is supply being sucked dry behind the scenes, and the next wave is about to hit. Think this is just market noise? Think again. Behind every number, every liquidation, every ETF outflow is a villain with a ledger. And when we pull back the curtain, you'll see just how deep this trap goes, and why your next panic could be their payday. Next up, Part 2, the crime scene of supply and inventory. where Bitcoin exits exchanges and vaults bleed dry. We'll expose the moves that the media pretends don't exist. Every coin counts, and every move tells a story of orchestrated accumulation. While the retail bloodbath raged, the exchanges were quietly emptying. Coinbase, Binance, Kraken, all reporting circulating BTC balances dropping like sand through a sieve. Total circulating supply now sits around 19.98 million, while corporate treasuries hoard 1.17 million BTC. Think of it like COMEX vaults bleeding gold, digital scarcity being engineered under our noses. Every coin that leaves an exchange isn't just a number. It's leverage, control, and a silent signal that someone bigger is moving the pieces. Here's the kicker. Open interest in futures sits at $95.6 billion. That's paper BTC dominating reality. Retail traders are dangling on thin leverage lines, thinking they own risk, while the system has already pre-decided who profits and who bleeds. Forced liquidations don't happen by accident. They're engineered. Each $217 million retail wipeout funnels liquidity directly into the hands of institutions quietly accumulating below 65K. The leverage trap isn't theory. It's a machine, calibrated for retail panic. Now the villain arc gets vivid. BlackRock's $10.7 billion ETF moves weren't just trades. They were rotations designed to shake the weak hands. $276 million BTC outflows disguised as panic selling, while $129 million ETH inflows quietly signal confidence. JP Morgan and the Fed? They don't need to announce their moves. They engineer volatility, support the swings, and let the headlines scream, extreme fear grips crypto, while retail sells the dip. Every spike and crash is a controlled burn. Here's the bait and switch in full technicolor. Drop BTC to 60K, retail panics, margin calls hit, liquidations spike, headlines flash chaos. Meanwhile, whales buy cheap, orchestrated under the cover of media hysteria. The market rebounds, leaving retail holding the losses, institutions holding the accumulation. This isn't random, it's a replay of history. FTX collapse, March 2020, COVID crash, liquidity squeezes, panic exits, accumulation by a few, rebound for the system. The cycle repeats, but the players adapt, making each round more invisible, more surgical. Volume analysis reinforces the story. Exchanges show BTC withdrawals, futures contracts remain heavily leveraged, and ETH staking surges. The pattern is clear. Extract retail liquidity, move supply off exchange, lock it in treasuries or cold wallets, and let media spin natural volatility. Supply is being drained strategically, creating digital scarcity, while the masses fight over red numbers on charts. And it's global. The next twist isn't just US whales. East versus West flows are about to rewrite Bitcoin's global ownership map. Asian exchanges, Middle Eastern vaults, European institutional wallets, every movement of BTC off public ledgers tightens the chokehold on liquidity. What looks like a decentralized network is actually a game of high-level monopoly, played behind firewalls and custody agreements. Here's what retail doesn't see. The orchestration isn't chaotic, it's meticulously timed. ETF rotations, paper futures leverage, media panic cycles, and withdrawals from exchanges all happen in sync. Think of it like a heist. The alarm goes off, market panic. The crowd screams, retail sells, and the thieves, institutions, collect the loot in silence. Every cycle leaves fewer coins in circulation and more consolidated in the hands of the few. The historical echo isn't subtle. Compare the March 2020 COVID crash. $3 trillion wiped off global markets, retail panicked, and the same whales who survived scooped up assets at fire sale prices. FTX collapse, retail trapped, liquidity evaporated, while institutional wallets absorbed the supply quietly. The current BTC move is history repeating with surgical precision. The same blueprint applied on a larger global scale. Retail panic sells into engineered lows. Institutions quietly accumulate. Media spins chaos. Futures leverage ensures the weak get flushed, and the supply continues to bleed from exchanges to cold storage, creating the scarcity narrative that will fuel the next rally. Each coin leaving circulation is a domino, tilting control further towards the few who already hold the keys. But it's not just about accumulation, it's about rewriting influence. The next part will track these flows in real time, showing which global players are hoarding, which markets are being manipulated, and how US and Asian wallets are locking up BTC like a digital iron curtain. This isn't speculation, it's the crime scene ledger, and the footprints are traceable. And it's not just US institutions collecting the spoils. Arbitrage is screaming across time zones. While New York sleeps, Hong Kong and Singapore wallets are absorbing BTC at a premium. Shanghai traders pay more than the NY spot price, a silent signal that supply is flowing east. ETF inflows in Asia surge quietly, while US-based outflows paint a picture of redistribution, not panic. Every coin leaving Western exchanges seems to vanish into vaults nobody tracks, while the East quietly stockpiles, tightening the global chokehold on retail liquidity. Here's the kicker. Some of these wallets are unknown, almost ghost-like. Analysis of on-chain movement points to massive hoards being accumulated by what can only be central banks or sovereign wealth funds. $100 million here, $250 million there. Over days and weeks, billions quietly shift. Retail traders see a dip, panic, and sell, while the real buyers move in silence. Fewer coins are available to the masses, and every forced liquidation pushes the eastward flow even further. The supply bottleneck isn't a theory. It's a strategic squeeze. Now add policy into the mix. The Fed delays rate cuts, the US tightens liquidity, and regulators signal caution. Meanwhile, Asia embraces crypto-friendly frameworks, creating a magnet for capital. Law changes, regulatory delays, and market signals are all part of a systemic handoff. The West destabilizes, retail panics, Asia accumulates. Volatility isn't random, it's designed. Each tweet, each policy shift nudges the market toward institutional accumulation, leaving retail holding short-term losses, while global players quietly consolidate long-term positions. Mining dynamics amplify the shift. US energy costs climb, difficulty rises, and domestic miners exit or scale down. Asia, particularly China-adjacent and Southeast Asia regions, dominates hash power. Bitcoin flow now increasingly heads east, increasing strategic scarcity for Western markets. Every coin mined in Asia is more likely to remain there or be hoarded by institutional vaults rather than circulate on US exchanges. Scarcity isn't theoretical, it's being written into the network itself. Now connect the dots. Bitcoin isn't just a commodity, it's becoming a geopolitical asset. Scarcity, strategic accumulation, and cross-border flows hint at a quiet challenge to USD dominance. ETFs and private accumulation suggest that the West may be losing its leverage over global crypto supply, while Asia positions to wield influence. Each regulatory tweak, each delayed policy move, funnels coins into hands capable of reshaping global financial strategy. Here's the replacement threat. Bitcoin scarcity plus adoption isn't a future problem. It's unfolding now. Global ETFs, sovereign hoards, and private vaults hint at BTC evolving toward a reserve asset status. Imagine a world where digital gold, Bitcoin, becomes a tool for macroeconomic leverage. The West may still print dollars, but these coins moving east aren't just investments. They're influence, control, and insurance against fiat depreciation. Retail panic now is geopolitical strategy later, and yet the narrative remains hidden. Headlines scream, "Fear grips markets," while the East quietly absorbs billions in BTC. Futures leverage ensures retail bears the pain. Exchanges report normal flows while wallets silently empty. It's a silent war, policy, liquidity, and mining power, all engineered to shift global ownership. The retail trader thinks they're fighting volatility, but the real battle is between continents and financial systems, played entirely behind the screen of price charts. Historical echoes appear again. March 2020, Western markets collapsed, Asia quietly accumulated. FTX collapse, same redistribution blueprint. Now every movement is amplified by ETFs, sovereign funds, and private accumulation. Each cycle leaves fewer coins in circulation, more consolidated in geopolitical hotspots, and retail trapped in liquidity swings engineered to benefit the few. And here's the chilling part. This isn't over. The east-west flow, strategic accumulation, and mining dominance signal systemic strain. The market isn't just being manipulated, it's being rewired. Supply is consolidating, volatility is amplified, and institutional positioning is silently preparing for what comes next. Every piece of this puzzle points to a system teetering on the edge. U.S. debt has blown past $38 trillion. Japan's bonds wobble under stress, and global sovereign debt sits at historic highs. Interest costs are climbing, and no economy can escape the trap. Weak data triggers panic, the Fed prints, liquidity floods the system. But here's the kicker. Inflation explodes, and every move to stabilize only feeds the chaos. Now watch what happens next. Crypto becomes the lightning rod. Retail panics at every dip, selling into squeezes engineered by whales and ETFs. Bitcoin demand surges, but supply tightens. Eastward accumulation continues. Coins vanish from Western exchanges, and futures leverage ensures retail bears the brunt. ETH staking queues swell, signaling institutional confidence, while retail bleeds out. Every liquidation is absorbed, every panic move exploited. The system isn't broken by accident. It's designed that way. Here's the trap. Banks are overloaded, leveraged to the hilt. Retail is exposed, over-leveraged on margin. Institutions quietly hoard, quietly stake, quietly survive. Volatility isn't just possible. It's inevitable. Another flash crash is baked into this architecture. BTC could retest 50K if retail capitulates. ETH could slide to $1,400 as ETF rotations accelerate. Meanwhile, smart money continues stacking coins in treasuries, staking, and vaults far from exchange eyes. Look closer. Every macro lever points to the same outcome. Rising rates, debt stress, and a weakening dollar amplify crypto's role as a hedge. But the system's fragility makes these moves violent. Retail thinks it's trading. It's actually participating in a slow-motion wealth transfer engineered by global institutions and policy architects. Every headline, every Fed announcement, every regulatory delay nudges the market toward the inevitable squeeze. And now, the call to action is urgent. Get out of banks. Move your crypto into self-custody. Stop letting Wall Street dictate your losses. Every coin in your wallet is a bulletproof vest against the engineered chaos. Every moment you delay is another opportunity for the system to bleed you dry, while institutional players quietly fortify their positions. Finally, the philosophical truth. This isn't just about money. It's about control. In a world rigged to concentrate wealth, freedom isn't in the market, it's in your hands. Hold your keys, hold your future. The system can't touch what you secure yourself. Macro doom is here, volatility will spike, and retail is trapped unless action is taken. Bitcoin isn't just a speculative asset anymore. It's a hedge, a weapon, a lifeline. Stake, secure, accumulate. The next move belongs to those who prepare, not those who panic. In short, the system is rigged, the trap is set, and only self-custody ensures survival. Mic drop. Freedom isn't handed down by institutions. It's held in your hands, literally, in the keys that protect your wealth and your future. If this blew your mind, hit that like. It tells me you want the real, unfiltered crypto truth. Smash subscribe and turn on notifications. You can't afford to miss the next move these institutions make. Stay alert, stay liquid, and remember, your keys are your freedom.